So this is how I beat the market with 3 simple strategies and how you can too.
Do you have a desire to build wealth? Of course you do. What if I told you that the old saying, you can't beat the market, is complete BS? I don't just show you where, but how to be a contrarian investor and hit your investing goals out of the park.
Now, have you ever wondered why some investors seem to beat the market without much of an effort, while others really struggle to make any significant gains? Meanwhile, most financial gurus are out there telling you that you can't really beat the market because 89% of professional fund managers fail to do so. So I'm sure you want to be super successful like Warren Buffett and the likes, but you've also felt discouraged by these financial gurus. It's hard, right? I mean, today I'm giving you validation that yes, it is possible. And no, it is not just pure luck, and you don't have to be a genius. I've done it myself. Since 2016, I've had total returns of over 20%. To be more precise, 26.5% on my total net worth, not just my investments, including money I never invested while going through a period of losing 5 different business ventures and dealing with corporate debt. Yeah, I know stuff dreams are not exactly made of. So here are the 3 unconventional strategies that made this all very, very possible. Now, the first way is to go cyclical. Investing in assets that are cyclical is a way that in the long term can yield multiples of the capital that you invest. Now, these are your roller coaster investments. They're kind of linked to the economy and how it's doing, or the perception of how it's doing, right? When the economy is on fire, firing on all cylinders, booming, some of these stocks can be the true life of the party. Now, they'll be doing great because they're often tied to, say, the resource industry or luxury goods or services. Now, think about it. When people feel flush, they're more likely to splurge on those nice to haves, right? Or when the governments are writing checks for massive infrastructure projects, anyone in the metals, oil, and cement business will invariably win. Now, when the economy hits a rough patch, they're often the first to feel the pain. This category can be more of a wild ride compared to the more stable cousins, the defensive stocks, which people need rain or shine. Now, let's take a look at a multinational mining company, Anglo American. The early 2000s saw the start of a commodity bull market in which China's needs for commodities seemed endless. At the same time, investments in new mine capacity really lagged, which led to soaring commodity prices and also company profits. So during the 2000s, the mining companies used these profits to invest in new mine capacity to meet the ever-growing Chinese demand. Now, prices swing wildly based on economic outlooks, making the sector not for the faint of heart. But here's where it gets interesting. Investing in cyclical assets like gold and silver stocks, for example, when they're at their very lowest, can bring in returns that are nothing short of spectacular. You might know about this. Now, imagine seeing your investment skyrocket 300, 500% in a bull market. It's like compressing 20 years of average returns into just 5. Now, I'm not even going to go into the infamous 10 baggers that do happen in this industry from time to time in gold, copper, silver, uranium, and some more obscure commodity stocks like niobium, which you do get to hear about once you start dipping your toes in the water. But, and this is a massive but, you've got to know what you're doing. This isn't a dive in headfirst kind of deal. Yes, you do have to know what you're doing, and that often means being guided by newsletter writers at first to kind of understand how the industry works. But if you're disciplined and you keep a good portfolio balance, you might just fall in love with it like I have for the last decade and never look back. However, it's not all sunshine and rainbows. Investing in commodities like mining comes with its fair share of risks. Ever heard of Buffett's advice? Be greedy when others are fearful, and fearful when others are greedy. This is your mantra if you're stepping into the cyclical world. Absolutely 100%. Mining is a tough gig. You've got to stay on top of the game, because in the world of mining, if something can go wrong, it probably will. That's my personal motto when it comes to investing in mining stocks. So what's the takeaway here? The ideal time to jump into cyclical stocks is when the economy or the demand for that particular commodity is just beginning to pick itself up. It's a challenge, yes. It requires you to bet against the prevailing mood, to invest when others are running for the hills, when it's not sexy to do so. But that's exactly where the opportunity lies. Remember, the key here is courage and timing. And yes, a bit of patience goes really a long way. If you get it right, the rewards can be extraordinary, propelling your investment to heights that far exceed those steady yet yawn-inducing average returns you'd otherwise be getting by just, say, investing on the S&P 500. The second way is to go exotic. If you don't want to go cyclical, you can go exotic. You know why these financial gurus are saying that you can't beat the market? They are advocating for investing in index funds that track the market and focusing on the lowest fees possible in order to maximize gains. This makes sense if you want to devote no time to understanding what you actually own and are happy with an average of, say, 7 to 8% return per year. That's fine. But if you want to beat the market, you need to have the amount of knowledge to beat the general public as well. So this isn't about pouring your hard-earned money into, the giants of the stock market, right now, the Mag 7 or something like that, the trillion-dollar behemoths we all know. Nope, it's about casting your net wider into waters less traveled by the average investor and pulling returns from corners of the globe that might actually surprise you. So what does this actually mean? Well, you see, investing in foreign stocks, like say those in Brazil, yes, where I'm from, Russia, or even India, for example, presents a very unique opportunity. Brazil's market is historically and painfully undervalued, making it ripe for the picking. Russia, despite its massive volatility, offers stocks with very low price to earnings ratios. And what about India? Well, it's on a trajectory of massive economic growth, fueled by a growing middle class and also lots of technological innovation that you've probably already seen or heard. But why bother with these really exotic places? Well, for starters, higher dividends. Less competition means your investment can grow without the constant challenge from, the newest startup vying for a piece of the pie. This is because of a little secret that many may not tell you about. But as someone like myself, who was born in a third world country, I can testify to this. Large companies in developing nations have a really strong upper hand of tax, access to capital, and legal benefits that startups are usually completely cut out from. In these emerging markets and frontier markets, you may be dealing in equities, currencies, and sectors not typically in the spotlight. So what actually makes them attractive? Well, emerging markets with their super quick development and untapped resources, they often offer a growth potential that's very, very difficult to match. So unlike the developed West as we know it, because they're not on the main stage for analysts and mainstream investors, you may find opportunities and valuations that others in general might completely miss. Now, how do you tap into this potential? Obviously, it starts with research in each of these potential countries or regions, understanding first the political, economic, and cultural landscape of these markets is absolutely crucial. And it's not just about numbers, it's about context. Getting insights from local experts, people with boots on the ground, is also key to avoiding pitfalls. Now, most importantly, risk management is going to be your compass here. Exotic markets come with their fair share of risks, from political instability to crazy currency fluctuations. Diversifying your investments and keeping a super keen eye on your portfolio will help you to navigate these waters a little bit more safely. For example, in India, tech and consumer goods sectors are booming right now, offering a chance to invest in probably the next global success story. Remember China? Well, anyway, frontier markets like Brazil and Nigeria, what about them? They're not just emerging, they're actually cheap and offer tons of potential. Oil countries, anyone? Remember, going exotic is not about super quick wins. It's a long-term game requiring you to be patient and having a vision that extends beyond the immediate horizon. Volatility of these markets means that, yes, you'll need to get ready for a very bumpy ride, but the destination could be well worth the journey. Now, with careful research and local insights, if you keep your discipline to risk management, investing in these less charted territories can really enrich your portfolio in more ways than one. If so far this is making sense, make sure to subscribe and hit the bell icon so you won't miss any of our future insights. And now the third way is to go niche. Becoming really knowledgeable about one specific niche over the long run is probably the most common sense yet least practiced strategy that I've seen. Now, imagine being a die-hard fan of, say, a music genre, say indie rock, and knowing all the underground bands before they hit the big time. Now, apply that to investing. This approach isn't really just about spreading your bets. It's about leveraging what you're genuinely passionate about, be it tech, fashion, or anything in between. For example, if shoes are your game, then imagine identifying the next big collaboration that's set to skyrocket in value before anyone else catches on, and catching in on what you know to be true before the masses realize it. Now, how do some investors get it so right? Well, some use technology to monitor social media trends or to identify arbitrage, catching wind and gossip of what's gaining traction before it becomes the real news. Take, for instance, Chris Camillo. He's developed a strategy of watching X.com commentary, back then, good old Twitter, to scan for positive comments of consumer goods made by companies that were publicly traded. Now, when the product was a hit with its fan base, he would be able to predict the sales would go up with said stocks and would gain a lot of value in a short period of time, say next quarter. And he turned a modest portfolio of 20K into several million doing just this. That was it. That was a strategy to pick up on Twitter gossip. Glorious. But you don't need to be a whiz kid to make this work. By immersing yourself in your chosen area and keeping in the loop of every development, and truly understanding the ins and outs, you'll naturally spot opportunities that, an outsider might often miss. I'm not going to lie, fine-tuning your strategy to this level takes a lot of time and it takes a lot of effort. Yet the potential for returns is probably way, way, way higher than the norm if you think about it, like the Chris Camillo case. And it offers you not just financial gains, but probably a really high return in your interests and hobbies. Warren Buffett does talk about investing within your circle of competence. This niche strategy that I just mentioned embodies that philosophy to a T. By investing in what you know best, you're not just playing the market, you're making very well informed decisions in an area where your knowledge gives you a distinct advantage. That's your edge. This could also probably reduce your chances of having sleepless nights and being confident that there's noise along the journey. Now, if you're up for a challenge and ready to engage with investing on a deeper level, focusing on a niche could not only set you apart from the average investor, but also turn your passions into a very, very profitable venture. As we've explored these 3 powerful investing strategies, remember how we started this. Questioning what sets successful investors apart. It's not just about the strategies themselves, but how you apply them with consistency and also good old discipline. It's true. Power lies not just in the strategy, but in your commitment to learning and adapting. If you want to know specifics on strategy number 1 and to know exactly how I found a stock that multiplied very quickly and how I could have done even better, then check out this video right here.